Hey there. Today, we're diving into something you probably use every single day but might not think too much about: money. Meet Bob. Bob lives in the US, where he uses US dollars daily. But Bob loves to travel, and on his trip to Germany, he realizes something odd: one US dollar is worth only 90 cents in euros. Then, when he heads to Vietnam, suddenly, one US dollar equals 25,000 Vietnamese dong. Hold on, why is that? Why isn't $1 equal to €1 or 1 dong? And why do exchange rates seem to change every second? Today, we're unraveling the mystery of currencies, exchange rates, and why money isn't the same everywhere. Before we explain why currency values change, let's take a quick trip through history. A long time ago, money was directly linked to gold, a system known as the gold standard. This meant every piece of paper money was backed by an actual amount of gold. So, countries couldn't just print more money without having more gold to back it up. It kept things stable, but as economies grew and global trade expanded, this system became unsustainable. By the 1970s, most countries abandoned the gold standard and switched to fiat money, a currency that has value simply because the government says so and people believe in it. That's why some people call it fake money. It's not backed by gold, silver, or anything physical. It's backed by trust. The more people believe in a currency, the stronger it becomes. But if trust is lost, well, just look at countries like Venezuela or Zimbabwe, where hyperinflation destroyed their money. Alright, now let's get into why some currencies are stronger while others are weaker. It mostly comes down to supply and demand. The more people want a currency, the higher its value. If fewer people want it, the value drops. So, what makes a currency desirable or undesirable? Let's break it down into 5 key factors. 1. Inflation, the silent currency killer. Inflation happens when prices rise, and the same amount of money buys less than before. For example, in 2022, you could buy 2 loaves of bread for $10. But thanks to inflation, by 2024, that same $10 might only buy you 1 loaf. Your money loses value over time. A real-life example of extreme inflation? Zimbabwe. In the 1980s, 1 Zimbabwean dollar was worth more than 1 US dollar. But because of bad economic policies, corruption, and excessive money printing, Zimbabwe's currency crashed. By the 2000s, 1 US dollar was worth 600,000 Zimbabwean dollars. It got so bad that Zimbabwe eventually abandoned its own currency and started using the US dollar and other foreign currencies instead. Lesson: printing more money doesn't make a country richer, it just makes the money worthless. 2. Interest rates, the currency magnet. You've probably heard about interest rates, but why do they matter so much? Interest rates are essentially the cost of borrowing money. When they're high, investors flock to that country because they can earn better returns on their money. And guess what? To invest, they need to buy that country's currency, which increases demand and makes it stronger. For example, if US interest rates are higher than Germany's, investors might sell their euros and buy US dollars to take advantage of better returns in America. This strengthens the US dollar while weakening the euro. But there's a catch: high interest rates also make borrowing expensive. That means fewer people buy houses, businesses take fewer loans, and economic growth can slow down. So, central banks must carefully adjust interest rates to balance growth and stability. 3. Political stability and foreign investment. Imagine you're an investor looking to start a business in another country. Would you pick a place with corrupt leadership, frequent protests, and constant economic crises? Probably not. Investors prefer countries that are stable, have low taxes, and offer business-friendly environments. When China opened its markets in the late 1970s, foreign companies rushed in to set up factories, hire workers, and do business, all of which increased demand for the Chinese yuan, making it stronger. On the other hand, Countries with political instability scare off investors, making their currency weaker. If businesses fear sudden policy changes, protests, or economic collapses, they'll take their money elsewhere. The stronger and more stable a country's economy, the stronger its currency. 4. Exports versus imports. The Currency Balancing Act. Currencies also gain strength when a country exports more than it imports. For example, when Japan sells cars to the US, American buyers need Japanese yen to pay for them. This increases demand for the yen, making it stronger. But if a country imports more than it exports, it needs foreign currency to pay for those imports, which weakens its own currency. One reason the US dollar remains strong is because oil-producing nations agreed to sell oil only in US dollars, a system known as the petrodollar. Since nearly every country needs oil, they must buy US dollars first, increasing global demand for the currency. 5. Fixed exchange rates, the shortcut to stability. Some countries peg their currency to a stronger one to maintain stability. For example, Brunei pegs its currency 1:1 with the Singapore dollar, meaning their values are always equal. Likewise, Belize pegs its currency to the US dollar at a fixed rate. This makes trade easier and more predictable, but it also means these countries depend on the economic stability of the country they're pegged to. If the US dollar crashes, the Belize dollar crashes with it. A single world currency sounds great in theory, no more exchange rates, no more conversions. But in reality, it's not that simple. Take the euro, for example. It allows countries to share one currency, but they also lose control over their own monetary policies. When Greece had a financial crisis in 2009, it affected the entire Eurozone. If the world used a single currency, one country's mistake could trigger a global financial disaster. That's why countries prefer to keep their own money and economic policies separate. So, should every country aim to make its currency as strong as possible? Not necessarily. A country that imports a lot, like Singapore, benefits from a strong currency because it makes imports cheaper. But a country that exports heavily, like China, might want a weaker currency to make its products cheaper for other nations. That's why some countries intentionally lower their currency value, a practice called currency devaluation. If you want me to make a video explaining how currency devaluation works, let me know in the comments. And don't forget to like, share, and subscribe for more insightful content on finance and economics. See you in the next video.